Good morning, traders. It's Marvin from Trailblazers Trading View. And like I promised you guys from the last video, this is the supply, demand, and market structure video. Though it may take time, but I'll advise you guys to stick around and make sure you get as much valuable information from this as you can, because this is obviously free. Right, so let's get straight into it. Under this market structure section, we're going to be explaining the types of market structure, structure breaks, multi-time frame structure mappings, then supply and demand zones, textbook examples of both, then our factors for validating supply or demand zones, and that's the end of the slide. So let's get straight to the market structure thing. So market structure here, I would define market structure as basically the framework of a price chart, and it's a very important concept to understand while trading, not just as regards to our strategy here at Trailblazers Trading View, but I think as regards to other strategies too, because it's a very well known concept, the market structure thing, and you must be fully aware of wherever you are in structure for you to know if you are swing trading, or intraday trading, or scalping, and yeah, basically that's just it. So let's get straight to it. So types of market structure, we have the bullish market structure, where price keeps making series of higher lows and higher highs. This is a textbook example of a bullish market structure. Obviously, the price chart is not as clean as this. If it's as clean as this, obviously everybody will be making billions of dollars and stuffs. So this is a bullish market structure. Then for the bearish market structure, we have this where price is making series of lower highs and lower lows. And we have the consolidating market structure. Popularly referred to as support and resistance. This is what retail traders refers this type of consolidating market structure to. But as an advanced trader, we see this as a liquidity pool. Liquidity will be another topic that will be explained. Maybe I don't know what video I'll do that in, but it will be a whole other topic for me to talk about. Now coming back to this, a bullish market structure. A bullish market structure, price respects demand zones in a bullish market structure. Price respect what? Demand zones. Then in a bearish market structure, price respects supply zones. And like I said, this is just um textbook explanation of what a bearish or bullish market structure is, or consolidating market structure. Coming into the real markets, they are not as clean as this, right? So when you're having a bullish market structure, price must be making series of higher lows, higher highs, higher lows, higher highs. Whatever higher high is forming should be taking out the previous high that was formed. Just like this. This is taking out this. The low should be higher than the previous low that was formed. So the high should be higher than the previous high that was formed, and the low should be higher than the previous low that was formed. Look at this. This was the high, this was the low, higher than this one. Then this low made this one that was higher than the previous high. Then the low coming back down was higher than this one. So yeah, that's for the market structure. There's nothing too special about it. Just that price makes series of higher lows, higher highs, higher lows, higher highs. Then for a bearish market structure, we have lower highs, lower lows. Now the lower high should be lower than the previous. The lower high should be lower than the previous lower high that was formed, and the low should be lower than the previous lower low that was formed. So here you have it: lower highs, lower low, lower highs, lower low, lower highs, lower low. Price respecting what supply zones. In this type of consolidating market structure here, this is where they retail traders tell you that if you see a resistance zone, you should sell on the resistance zone and you should buy on the support zone. Shout out to whoever is using the strategy and is consistent with it. That's something. When I was using the strategy, I didn't find anything like consistency with it. So yeah, basically this is the type of market structure that the price chart ascertains at times: the bullish, the bearish, and the consolidating market structure. Now, structural breaks. We have one body to body break of structure. We have wick to body break and we have body to wick break. Do I need to write that down? You guys can actually understand what I'm trying to say. Where is this text thing? Okay. There's no need of writing anything. We have the body to body break, we have the wick to body, and we have the body to wick break type of structural breaks, right? So back to market structure. What we look at here at Travis as if market is making series of higher lows and higher highs, respecting demand zone again, the high that should be formed whenever the high that's to be formed is surpassing this, it's called a break of structure. Whenever the new high that's to be formed surpasses this, it's called a break of structure. And we make sure that the candle, irrespective of the time frame, is closing above this. This is called a body to body break. Whatever time frame, like I said, bullish market structure, lower highs, higher lows, higher highs, higher lows. Then this high should, once it's crossing this high, it's a break of structure, and look for a candle closure of that. Now the body to wick or wick to body is whenever you see price closing above this previous high with a wick. We don't use that here at Trailblazer, so I'm not going to touch more of it. So that's it for a body to body break. Then wick to body is quite same thing. You have the wick closing above this high. We don't even look at that. So what's the next topic on the slide? um Multi-time frame structure mapping. This is a very important concept that you must pay attention to. Multi-time frame structure mapping. Now say you have price doing like this, creating series of higher lows and higher highs on the 4 hour, for example. How do you think structure on the 15-minute time frame would look like? Obviously this, you have what they call complex pullback or retracements. Price would make a series of higher lows and higher highs in just this push on the 15-minute time frame, for example. This is how structure will be forming. And many traders tend to confuse themselves with this type of structural form is you just need to understand that if you're trying to trade from the structural formations from the 4 hour time frame, you're looking for a swing position, and whatever structural formation is going on 50 minutes are for intraday traders and scalpers at times. So you shouldn't confuse yourself with this too much, because whatever structural formation is on the 4 hour time frame or the higher time frame or say the daily are for those that are looking to get into swing positions. So yeah, that's that on the market structural mappings. Obviously, I won't go too detailed in it because this is YouTube. Only our students like will get everything that you need to know. But basically, this is all you need to know. Don't confuse yourself with the structural formations that are there on the 15-minute time frame. Whatever is here on the 15-minute time frame or the 10 minutes or the 30 minutes is basically complex pullbacks and retracements, and these are for intraday traders, like I said. But you must be well aware of wherever you are in time and in structure. Even as intraday traders, you must still understand and know that okay, the higher time frame, which is the daily or the 4 hour, is still very important for me to look at. So I know wherever I am in structure and in price, so I know how to position myself, right? So that's that on structural mappings. Then we go straight to the next topic on the slide, which is supply and demand zones. So as is written on the screen, supply demand. This is how I understand or what I see a supply or demand zone to be. A supply zone is an area on price charts represented by candlesticks where there is usually pre-monumental selling pressure, eventually transitioning to a downward trending market and breaking structural point. A demand zone is an area on the price chart represented by candlesticks where there is usually pre-monumental buying pressure, eventually transitioning to an upward trending market and breaking structural points. So this is a textbook example of a demand zone. And if you refer back to the market structure part where I was saying price making series of higher lows and higher highs and respective demand zones. This is basically what it is. Now you'll be like, how do you know what a demand zone is? Chill, I'll explain that and give you factors for validating demand zones or what you call other blocks. So this is a textbook example for a demand zone. Same thing goes for a supply zone too. Series of lower highs and lower lows, lower highs, lower lows, lower highs and lower lows, lower highs and lower lows. And factors for validating supply or demand zones. Now, the zone, did it break structure? Did it create imbalance? Did it take out liquidity? And you question the candle mitigation. Now, let me take you back to my charts and try to explain what I mean by supply and demand zones. Now, let me go to the 1 hour or okay, see from here, price was making series of high lows, sorry, lower highs, lower lows, lower highs, lower lows. And price switched structure from here. Then it came down, respected a demand zone, went up, came back down, respected a demand zone, and that was what price was just doing. So here, let's try to understand whatever was happening here, right? So you can see this zone that was formed here. this other block that was formed, this demand zone, it had, let me take this back. We can say that, okay, as it broke structure, now you question yourself, what is the best demand zone to pick? Obviously, it's this one, because it had this imbalance, this imbalance right after the structural break. It broke structure, imbalance, but did it take out liquidity? No, not in this type of thing, not in this type of scenario. And just watch what price did. Price came back down. When the price came to mitigate the demand and then it shot back up again. And that's what I mean by question candle mitigation. If it was to be a case where some traders will tell you that, okay, you pick the, I think the last, the I don't know how to explain this, but I know there are some instances where some people have messaged me and I'll be like, that's not the right way to pick a demand zone. Some will tell you that this is the right demand zone from here. Some will tell you that this is the right demand zone. This is the right demand zone. But to me, I'll prefer this one. I will come back and just do what it wants to do. And price kept trading higher, breaking structure, creating series of demand zones, created this, created this, broke the structure again, broke structure from here, created this zone, reacted to it, went back up. So that's basically a demand zone scenario. Then let me try to see for a supply zone scenario. Mm, supply zone, supply zone, supply zone. I'm not seeing any clear supply zone here. That's why I've not actually picked the zone to show you guys. Okay, I think I've seen one. Market making series of lower highs and lower lows, lower highs and lower lows. You see how price came right to that zone. Because why did I pick that zone? Broke structure from here. Add Add this little imbalance just right after it. This little imbalance. Here. That little imbalance just right after the zone. So that was why I picked the zone. So now you see if you refer back to the factors for validating supply or demand zone, it broke structure, created imbalance, didn't take out liquidity, question your candle mitigation. The candle wasn't mitigated. So that was a valid supply zone that whoever seen that would have traded it off it. So that is that supply or demand zones. So now let me show you guys this the thing that I was explaining, the multi-time frame structural mappings on the 4 hour and 15 minutes, so you can see it and compare yourself. Okay. The price is making lower highs, lower lows, lower highs, lower lows, lower high, lower low, lower high, lower low, lower high, then the drop. Now I'll focus on the most recent swing high, which is this from this swing point to this, and let's see what actually happened on the 15-minute time frame. Now we can say that just we had this swing point on the 4-hour time frame, on the higher time frame. Just that swing point from here to here on the 4-hour time frame, right? But coming to the 15-minute time frame, see that what price was creating its own internal structural point. You can see it. You can see it. So this just goes to show that we need to be aware of where we are in price, or where we are in price and in structure. So yeah, so yeah, that is basically that. Let me check if there's anything I need to cover again. I think that's all. So I explained market structure to you already, the types, structural breaks, multi-time frame structural mappings. Obviously you need to go back and do your own backtesting and stuffs. Supply demand zones. I gave you my own explanation of what I feel supply or demand zone is. Showed you guys like a textbook example. Then I gave you the factors that we use here at Trailblazer for validating our supply or demand zone. This is very important. This is very important. Did it break structure? Did it create imbalance? Did it take out liquidity? Then you question your kind of mitigations. So yeah, that's basically everything as regards market structure, supply demand zones. I wanted to make a video explaining liquidity, but that will not be now. I will still do that though, but it will not be now. So if you find the video helpful, smash that like button, subscribe to the YouTube channel, turn on your post notification, and yeah, we'll see you in the next video.